there a mic? You just, sure. Oh, yeah.
Yeah, the mic is still full seat.
What's right? Oh, we have to swap.
I'm the founder of Morpho.
Start this way.
All right. Okay, welcome everyone to Liquid Session, the current lending market landscape. I'm Camille Russo, the founder of The Defiant. Hopefully your source for all of DeFi and Web3 content. And I'd love for the panelists to briefly introduce themselves and their protocols.
Okay, well, firstly, thanks to Phoenix Lab and everyone for inviting me to come here. Yeah, I'm Michael. I'm the co-founder and CEO of Euler Labs. We've spent the last year or so building out Euler v2, which is a modular lending protocol. So what do I mean by modular? Well, I think like some of the other projects here are building, bona fide products. Euler is less of a product in and of itself, and rather a very flexible and powerful toolkit for building your own lending protocol. So we like to think of it as more like maybe like an AWS with plug-and-play components, but rather than like AWS plug-and-play components for computing, it's plug-and-play components for building lending protocols. At the heart of the protocol, we've got two core modules called the Euler Vault Kit and the Ethereum Vault Connector. And with our Vault Kit, you can deploy vaults where assets are held for lending and borrowing. The vaults themselves are incredibly agnostic about everything, and so very flexible. They're agnostic about governance and oracles and risk and much more. And then this Vault Connector helps connect these vaults together and allows users to create fully fledged lending products. So you can really create any lending product with the kit. You can build things like Aave here, where you have a kind of monolithic like lending setup with risk management controlled by a DAO, or you can build unmanaged and ungoverned pools like the ones we have on Morpho Blue. You can build.
That's a good start, man. Go for it.
Sure.
You want to get your spice, my friend?
You can build things like DAI and much else. So yeah.
Hey all, I'm Monet Supply from Black Analytica. We're one of the OG sort of risk consulting companies in DeFi. We've been the original kind of risk contributors at MakerDAO since even before 2020, before the sort of DAO was fully formed. And we've also been working with a lot of other great projects here and there. We've made some dashboards with Aave in the past. We're working a lot on Spark. Working a lot on Spark to kind of dial in all the risks for the new products that they're launching, and just kind of keeping everything safe and sound.
Yeah, well, I'm Mark. I'm the founder of the Aave initiative, the ACI. We are a service provider to the Aave DAO, and Aave is the leading lending protocol in the AVM ecosystem.
Hi everyone, I'm Paul, CEO of Morpho Labs, and we're building the Morpho protocol. We used to be building on top of Aave and have a protocol called Morpho Optimizer, optimizing the interest rates of Aave. We've been doing this for 2 years, and a few months ago we released a new lending and borrowing primitive, which is permissionless, immutable, and governed, and that leaves room for modular layers on top to recreate pretty much anything you want. From liquidity aggregation, from risk management, account abstraction, etc. And yeah, thanks for having us.
Cool. Maybe for Monet, just to understand how Maker and Spark fits into the lending landscape.
Yeah, that's a great question to kick off. Spark is kind of like an extension, in a way, of MakerDAO. They are developing a lot of innovative new ways to put capital to work. Maker is, I would say, the oldest, kind of most established decentralized stablecoin, so it has a pretty big supply. It has like a huge pool of capital, but much of it is, recently it's been idle, in some of it in USDC, some of it in T-bills and other sort of off-chain structures. So Spark has been, developing a lot of new conduits to put this capital to work and address the sort of like real yield demands in the DeFi space. So an example of that is the Morpho vault that we've launched recently with Athena, basically allowing capital from DAI and from Maker to get deployed into basis trading and basically provide liquidity indirectly to centralized exchange traders. I think one thing that I think is maybe not commonly understood, but the way that we kind of internally look at MakerDAO is very similar to other lending protocols, though. If you hold DAI or if you hold SDAI or DSR, it's very similar to if you were depositing USDC or depositing a stablecoin into a lending market like Aave or like Morpho Blue or Euler. So I think there's a whole lot of similarities between a stablecoin protocol like Maker and a lending market, and just the specifics of how sort of the capital is allocated on the back end and how the yield for these lending products is generated is a bit different, but there's really more similarities than differences. I would consider Maker to be a lending protocol just as much as a stablecoin.
Okay, and just to understand the difference between the different lending protocols in DeFi right now, if you could just like bring it back to the user level and explain why a user would use your protocol versus another one. Like, what's the specific use case for each?
Well, for Euler, I'd say
Do you have users?
Oh, yeah. Not yet. Okay.
If you had some user, why they would use Euler?
We'll take some of yours like last time. So I think the main benefit of Euler with the Vault Kit and the flexibility it brings is going to be the opportunity to access diverse risk-reward opportunities that just aren't there elsewhere in DeFi right now. Obviously, Aave has a lot of liquidity in users, but it provides really a single sort of opinionated risk-reward outcome for all of its users. And there are lots of people out there that want something more conservative or less conservative than what Aave has to offer. And with today's money markets, there really isn't an easy way to create markets that service those needs. And with the Vault Kit and its flexibility, you can create that. You can create those opportunities. So it comes down to flexibility and diversity of risk reward.
I think it's a great way to introduce things, and I think it's a very, very good panel in the sense that you have several degrees of the spectrum on the approach of lending. So yes, Aave is a heavily curated and market where we build experience for the users through the DAO votes and through the safeguards and the fail-safe of having governance and service providers that create those markets to create an experience where people trust Aave with their money. That means that we lose some market because it's very hard to use a shitcoin as a collateral within the Aave ecosystem. It's harder than on other ecosystems, but you know that if you deposit on Aave, you can come back in a couple of years, and there's a good chance that you will see some of your money back.
A good chance, yeah. Is that, are you including that big curve market in that shitcoin as collateral?
That's a good thought, yeah. That's why we have the safety module and not you.
Yeah, safety module, got it.
And I think it's a good way to introduce you, Paul, because I think you are in the middle of all that, in the approach.
Yeah, for sure. So I think maybe first I can start with Morpho Optimizer, which was like the initial product that we built on top of Aave. And really the reason we decided to build our own lending and borrowing stack is that over the last 2.5 years, the number of like incidents that we had to go through, and whether it's like at the smart contract level or there is like bad debt risk, etc., was incredible, frankly. And whether it was like because we were depositing and borrowing on Compound or on Aave, it's really been like, we did not feel comfortable building a multi-billion-dollar protocol on top of like a monolithic lending pool. And this is why we decided to build something we could feel confident actually building on top, right? And so I'll give you just a simple example around upgradability. Like whenever a lending and borrowing protocol upgrades, like in the monolithic pool, if you're building on top, you have to make sure that every single line of code that is changed does not affect your own protocol. That's months and months of work, multiple audits that needs to be done. So yes, there is a 10 days time lock when an upgrade happens on Aave, but I'm not sure like the Aave DAO checks if every smart contract pointing to this very specific, Aave instance and lines of code are actually like.
So what you say, it's too complex to have Aave, so you decide to externalize that to Gauntlet.
No, I'm saying it's impossible to build on top of Aave multi-billion-dollar protocol that you can truly scale, essentially.
Aave is a multi-billion protocol.
I mean building on top, right? So from this, we decided to go with an approach that's significantly different from the Euler one or the Aave one, which is really layered, where you have a core primitive that's really the safest like lending and borrowing protocol you could ever think of. 600 lines of code, formally verified multiple times by multiple tools. And on top of that, you have a very configurable experience. Like you can have the account abstraction you want, the risk management you want, you can expand different risk profiles, et cetera, et cetera. And so the experience on Morpho can vary a lot depending on the risk you're willing to take, both on the smart contract side and on the risk management side. So we have many different vaults built on top of Morpho. Some of them, are extremely, blue chip and safer than what you can have on Aave, for example, with maybe just like WBTC and STEs as collateral. Some others are fairly more risky. They have like 20 different collateral assets, and some of them are like LRTs, and it's, significantly riskier. So the experience on Morpho varies a lot depending on like the amount of layers of abstraction you decide to take, essentially.
I'll just put in a couple words about Maker and Spark, maybe of like what I see as maybe the underappreciated differentiation factors. The first thing for Maker specifically is we've been, for many, many months here, we've been setting a DSR that's well above what you can earn in traditional finance and T-bills, but we've seen that there's still maybe 2 or 3 billion DAI that's kind of sitting on the sideline and is not taking advantage of that. And for a user, I feel sorry for them that they, are checked out and they're not paying attention. But for the protocol and for other users who are a little more active, it's an interesting opportunity because Maker just has a lot of sort of excess financial strength and reserves, and sort of we're able to build up a lot more capital a lot faster. Scalar rewards for the people who are actively putting into the DSR, into SDAI, higher than we otherwise could have, and also provide more of like a capital buffer. So I think it's kind of like an accident of luck that Maker's in that position, but it is very interesting, and it's not easily replicatable with like other lending markets that are launching now. And then I think another factor with Maker is we're highly curated of like how capital is being deployed, what are the kind of risk assessments that are undergoing on it. So as a DAI holder, you kind of are, you have a bunch of professional sort of experience protecting you and trying to make sure that, we're making sure that DAI is just perfectly safe. Nobody has to think about, what their investment is in. But we also have the advantage of kind of a more modular style of asset allocation. So if we see, for example, Athena, we're able to earn, a 15% return allocating some capital there, we can put a little bit of money towards that without disrupting, the safe allocations that are forming the majority of the balance sheet on Maker. So lending against ETH or safe treasury bills. Things of that nature still are going to form the bulk of the asset allocation and kind of anchor everything with safety, but then we can kind of take a little bit of adventures on the side without disrupting that.
Okay, so it seems like the main differentiator lies on the spectrum of risk that you are wanting or willing for your users to take, with Aave being on kind of the safer side, and maybe Morpho on the other extreme, or Euler and Morpho?
Euler.
Euler and Morpho are the more like flexible
There's a
vault.
French connection here. Let's shit on the Brits.
So, Yeah, I would not put Morpho in the same category as Euler. Like, I think you have technical risk and market risk, right? And I think...
Right, it's not like platform risk is, that's
Right.
not a different discussion, but I'm talking about market risk, like having the flexibility of creating different vaults, like adding collateral that's maybe more volatile than others,
Yeah.
like having that level of flexibility.
Yeah, I agree.
Yeah.
Yeah, then in that case, Morpho is very flexible compared to Aave.
Yeah. And then on the Spark side, it's more about like providing more yield to or more returns to DAI holders through like deploying capital on different DeFi protocols, right?
My understanding is Spark is a facilitator to bring revenue within the MakerDAO ecosystem to finance the DAI saving rate. Would you agree with that, Sam? And you basically manage to find yield on-chain that will go to the saving rate and stabilize the DAI stablecoin. And I think you do a good job doing that so far.
Yeah, I think that's like Spark's edge, developing interesting new products that bring value to DAI, but also
So if they do that, what do you do?
avoiding losing money, you know.
Yeah, you just charge a call vault fee. That's it.
Okay, now going to the more, to the like broader use case for lending in DeFi right now. There's about 10 billion in outstanding loans in DeFi, 30 billion in TVL across different DeFi protocols. From what you've seen and your insights in your users, how are these loans being used?
It's actually very interesting. So what we observe from our experience at Aave, and I think you will correlate to that, is that there's 6 assets that actually makes money in DeFi. That's why we focus on a heavily curated approach on the Aave ecosystem, because there's actually no demand to provide liquidity as a counterparty for shitcoins. And when you look at those 6 assets, there's 3 main use cases. The first use case is Bitcoin and ETH as collateral to borrow stablecoin. And MakerDAO is very, very strong on that front. You have the leverage staking use case, so you have ETH and ETH correlated asset to borrow ETH in order to increase the staking yield or farm some points, because you know there's points now in the market. And then you have a third market that is a mix of that, where you will have a mixed approach. But when you look at every single other asset, it's, or at least on the Aave balance sheet, is a rounding error. So it's a rounding error in our balance sheet. That's why we are not very keen on exploring shitcoins as collateral or meme coins as collateral as a use case. We did, during the previous cycle, a lot of research on NFT as collateral, because that was the thing before meme coins. And the result, we spend a lot of time, money, and effort to see if that was an interesting market. And the outcome is that there's no Aave product using NFT as collateral, because we think the business is just not good.
Yep, cosign. I think Maker put in a lot of effort focusing on kind of long tail collaterals. In the last cycle, we had a bunch of different LPs. We had a bunch of kind of like mid-cap DeFi tokens, all great assets, but none of them really saw consistent demand. Maybe Chainlink, like Link, was like the one outlier that saw a decent amount of demand for a while. So yeah, it's all kind of, all the demand is driven from a few like sort of real yield drivers, staking revenue, and perp funding, and people who are either levering up or basically trying to avoid taxable gains on their really low cost basis cryptos. That's pretty much like just the juice that makes the entire lending industry go around, I think.
So the real question is that if there's 6 assets that matters, why the fuck I need 2,000 more for blue market?
Right, so I think currently we can agree that the short tail of assets is actually like the real use case of lending and borrowing right now is really like speculation. Like either like, leveraging on Bitcoin or STEs or leveraging staking yield or leveraging ETH in itself. And I think if lending and borrowing is really just that, then frankly, it's not such a big opportunity. Like if you look at traditional finance markets, like over-collateralized traditional finance markets, we're talking trillions of dollars of volume every day, and that's not just 6 different assets, right? And so I think, at least at Morpho, we believe in DeFi being able to change traditional finance as a whole, and not just like crypto, like being a tool for crypto speculation. So of course we've built a protocol that's really useful for the short tail of all assets, like WBTC, STs, etc. Like we enable very high like liquidation loan to values, for example, or with like extremely low smart contract risk, this kind of things. But at the same time, we've built Morpho Blue with the idea in mind that in the coming months and years, the use cases won't be limited to 6 assets. Like and if you look at the Aave roadmap, it's clear that it's focusing on being the best possible at those leverage use cases. I think it's really a matter of like mission and long-term vision for what lending and borrowing should be on-chain. And I think we diverge on this, that we think it's going to be much bigger than just those 6 assets.
But right now, are you seeing any demand for the long term?
No, for sure. Like right now, I completely agree with Mark. That's like most of the use case are this. I believe when interest rate will go down and like the perp funding rate will go below 5%, we'll see a lot of real-world assets as collateral, which will be probably very complicated for a monolithic pool to integrate because they have very specific like liquidation mechanisms. So I wonder how this is going to happen on Aave, but
don't worry about it, my friend.
I don't worry.
Okay, so it looks like yeah, there's a big kind of divergence in vision on how useful it is to provide the ability to have like the long tail assets as collateral, and we'll see which one is plays out. But it's interesting that, and we talked about this in our other panel, that right now like the main use case is really for lending protocols to provide a means of leverage to investors and traders, but there's really not there's not a lot of use of what you would call just like real world loans, like no mortgages, no loans for like building a business, or like personal loans for like, I don't know, buying a car or whatever. What's missing for this to happen? Can that happen with like over collateralized lending, or will DeFi need to find a way to do unsecured lending? Like, what are your views on this?
I would say, firstly, like the idea that there's unsecured or like uncollateralized lending doesn't really exist. Actually, like we call it that, of course, but actually you are always collateralized and always over collateralized with something, whether that's your purely reputation or staking your future income on something. But like usually the over collateralization is enforced through contracts, legal contracts that bind you, and regulation and enforcement of regulation by governments and government agencies and so on. So I think we need to see a maturity of the sector and work with regulators to help that happen more. But I think you can still represent the same those same uncollateralized systems in using the same kinds of protocols that we've all developed. Because if everything's already over collateralized, really what you need to do is then tokenize the collateral somehow, even if it's a liquid, and maybe not the kinds of tokens that we're talking about using as collateral here, like ETH and so on, but you can tokenize as an NFT or some other asset and enforce the proper liquidation mechanisms at play. These are the things that definitely the Euler Vault Kit is flexible enough to accommodate as we move forward in the future. I don't think we're there anywhere close today, but I think there will be, a lot of developments in the coming years, and these kind of use cases will come on chain and be represented through tokenization of these liquid other forms of collateral.
I think for the first of my and last time of my life, I would say I agree with you. Wow. But from what we learned on the market data, everything you say is absolutely correct, but who's going to be the liquidity provider? What's going to be the counterparty of these new exotic kind of collateral position, new type of assets that you can tokenize and things like that? And from what we learned, and that's actually based on our experience with Aave Arc, which was the version of Aave designed at institution, is that there's a lot of divergence between the demand side of liquidity and the supply side of liquidity, especially on this kind of markets. And our experience with that, and I think MakerDAO reached the same conclusion, and that's why we end up with Go, and DAI has gone in this direction in the previously years is that it's much easier to be the LP yourself as the protocol, as a stablecoin minter. And that's why I'm a bit wary, or I don't know how it would reach to do that as a pure lending marketplace or money market. If you don't have this element of minting your own asset and be, as the protocol, the liquidity provider, I don't know how it can work efficiently.
Yeah, I'm excited for like broadening use cases in DeFi lending beyond our current paradigm, which is just over-collateralized, basically margin loans of various forms. There's a lot more to lending than that. But I think in our experience at Maker in some respects, like we have to like be honest with ourselves, like is traditional sort of like counterparty-based credit underwriting and lending, is that our competitive advantage here in DeFi? I would say there are some very sharp people who do credit underwriting and sort of like RWA, the Steakhouse folks in the audience. But in general, I don't think that's our competitive advantage yet. So it's something that I'm excited for, but when we've seen DeFi protocols really try and just go in on credit underwriting and sort of the under-collateralized lending, a lot of issues have come up. Some of those, I forget which protocol, maybe it was like Clearpool or...
Do you think that's because of the protocol, though, or the actual technology, or just the implementation, the execution? Because I think it feels like they've underwritten some really bad loans, right? And that's a big part of the problem. But and maybe there was some like immaturity in the technology initially, but I think actually, maybe the technology is good enough, and it's just that we need better teams.
The technology might be good enough, but I doubt whether it's better enough versus just underwriting somebody with a bank. Go apply for a loan or a credit card with your bank. Is it 10x better than that experience to actually make it work in DeFi yet? Considering that all of the real talent for the credit risk evaluation is not with us now. It's still with those banks.
Is the missing piece like decentralized identity, like some sort of decentralized credit score?
Right, so I was actually going to bring this up. Like, I agree that over-collateralized lending and under-collateralized lending is, more or less the same thing. Like when you take a loan, like the people like providing liquidity will seek value and security in some sense. And the question is like, how can you tokenize all your value on chain? And I think right now we're not able to tokenize everything we have, because like our lives are not sufficiently like digitalized in some way. And so I think today really under collateral loans don't benefit from Web3 technology that much, except for settlement, which is like very, it's not that important. And I think we're sort of like multiple years away, in my opinion, from having like the primitives that are required in order to bring this value like on-chain, whether it's in identity, privacy. But I also think in general, it's just like digitalization of the world in itself that is required in order to get there. And only then, I think, with social graphs, identity, privacy, etc., we'll be able to do interesting things that you can't do in Web2, finance, in Web3. But my opinion is still a bit early.
So if that's the case, and DeFi lending will only be used or mostly used for basically margin trading, how big is the potential market?
It's huge in finance already. Yeah, when you look at the open interest on traditional financial market, it's actually huge. We have like 100x, 1008x growth potential, still with those 6 small markets.
1000x really?
1000.
That's 20 trillion, right?
That's maybe 100x. Yeah.
So I'd love to discuss. There's a bit of a controversy here between protocols that would be great to get into.
What do you mean? We're all good friends now?
I understand that Aave has made a proposal. I'd love to just learn more about the details of this proposal that Spark was using Aave's fork, and that you're now, not so happy about that.
That's all in the past. We're all good friends now. So you can expect on the governance forum new stuff happening in the next few days. It was a very productive week. And yeah, to new beginnings.
So did you, I mean, how is that actually?
Look at the journalist, she wants the scoop.
Yes.
You will wait on the forum because this is decentralized and governance is what matters.
We're among friends here, so how is that getting resolved?
Yeah, I mean, I can't say much, but I think in an ideal world, all of these protocols would work together a lot more seamlessly. And yeah, you know, whether that means putting capital into each other's products where it makes sense, where the risk reward's good, whether that means other sorts of integrations, you know, having adequate sort of like respect for each other's technical contributions, you know, elevating the vibes a little bit, you know, keeping everyone happy. So yeah, I mean, I think the vibes, you know, they've been better, and it would be great to, you know, get some of that DeFi summer energy
I think
back.
we all get along right. It's just, there seems to be...
And so what?
He still has 20 billion.
I have 20 billion reasons to not fucking care. But anyway, obviously the spice is fun, and otherwise it will be a boring debate and panel. But I think everyone benefits from the users to the lending protocols to the token holders and every single actors that are involved to create mutually beneficial systems where everybody has an upside.
That is so vague.
Look at you're a very good journalist. Maybe that's going to be on Infinite Machine Part 2.
Part 2, yeah. So, okay, but give me something concrete. Like, will Spark be able to continue using the fork or not?
We are an actual DAO, so no one in the world but the Aave token holder can decide that.
It'll be voted on?
It will be voted on, but I have good hopes that's going to be a good outcome on that. But we will see, because at the end of the day, when you own Aave, the asset, you own Aave, the protocol, and it's very important for us.
Okay, interesting. Okay, and then...
You're a journalist, I'm a politician.
All right, so moving forward, what are some of the milestones or products that you're all excited about to see coming either from your own products or more broadly in DeFi?
Well, yeah, I mean, I'm very excited for our product. Our launch is coming. We've been in development for a long time. Obviously, had a major setback last year, which was really tough, but we've come back stronger, and we'll be launching Euler v2 very, very soon. It's been a really long slog. There's been a lot of work on security, obviously. We're just going through the final throes of a massive Cantina audit that appears to have gone very well. And yeah, so hopefully everyone will help support us and welcome us back when we relaunch in the very near future.
I have to say, I have a lot of respect, and I will even say the word admiration by the fact that you don't give up and you still work and you come back with a better protocol. So obviously I will fight you to death because that's competition and I will punch you to the ground. But I love the fact that you come back to the arena to fight.
Thank you.
I respected you a lot for that.
Yeah, I think, you know, competition is great for the end user. Like, you know, we have fun with it too, but I think, you know, the end result of this is that end users benefit, lower margins, and just better products. Maker has a lot of exciting stuff upcoming. Endgame, you may have heard of it. Rebranding, a lot of new products coming down the pipeline with Spark. I think we'll probably just kind of keep it vague because, yeah, we're going to have a, you know,
sorry, there's the... So Spark is the first Maker sub-DAO to have a token, right?
It will be.
It will have its
It
own
will
token?
be. Yeah.
What's the timeline for
Soon. Soon.
Soon, TM. Okay.
Yeah.
2 weeks.
Oh, actually, just the replies to all their tweets, like, right? The scam replies. You just click on the link and you get your tokens.
Right, so I have to stay vague as well on what's upcoming from Morpho, but I'd say both on the product and the partnership level, I think we have things that have never been done in DeFi that are going to be super excited. I'm super excited about for the next summer in terms of like, adoption. So, yeah, unfortunately, yeah.
Partnerships?
Yeah, I mean both, right? Like, yeah, not much I can say, you know?
I think one thing that is important to push is that there's a lot of room for innovation in what we do. The lending and the money market vertical, and even DeFi as a whole, is far from super optimized. There's a lot of things that we can all contribute to. On the Aave side, there's going to be new markets very soon that will be optimized around specific use case, because as we say, there's few verticals that we believe are the most important and the most revenue generating, that generate the biggest use case right now. And we feel that we can optimize things on those markets, and that's a new frontier that we want to explore, especially in terms of risk parameter design, dynamic risk parameters, interest rate strategy, curves design, all this kind of stuff. So there's a lot of innovation that will be pushed, but I believe you guys will innovate as well. And at the end, I think the user will benefit a lot from all of that.
I think that's a good place to wrap it up.
Yeah.
Thanks so much for the time.